I remember when I was a kid, the first time I opened a brokerage account, I was a caddy for a little while, and so just like walked in with like $10,000 of cash.
In small bills?
Literally in dips. And I'm like, I think I should open a stock account. Because it was literally in a shoebox. 16-year-old kid. All these people are like, what?
They're calling in the authorities today.
And then one guy was like, you know what, I'll take a bet. And it did well.
Probably the best decision of his life.
Are we in a recession or are we not in a recession? And the answer is, that doesn't matter. The real question is, what sort of growth do we have to have in order to bring inflation durably back to 2%?
But let's bring in Unlimited CEO,
Unlimited Fund CEO and CIO Bob Elliott.
Bob Elliott, who previously worked on Bridgewater's investment committee. Bob.
Thank you for having us. Thank you for the invitation out here to the office. Looking forward to talking to you. Haven't seen you in about 7 months since the summit.
Yeah.
So what's been new with you? Catch us up.
Oh man, we're doing some great work at Unlimited. Building some new products using our return replication technology and making those hedge fund returns available now, not just to the sort of retail and advisor-oriented group, also looking to build products for institutions, and so that's been a big focus of ours. Because they suffer from the same problem lots of others do, which is that fees are too high.
Of course.
Lockups are long, fees are too high, and a lot of those institutions, you're a public pension fund, a lot of the constituents that you're facing and representing really are folks who don't think they should be paying billionaire hedge fund managers billions of dollars.
Of course. I mean, can you just break down the democratization of what you're trying to do, giving the average person access to the same returns that typically are guarded by accredited investors? Like, what are you really doing with the ETF, and what's the purpose?
Yeah. I mean, for most folks who are investors, if you're an everyday investor and you have, less than, $25 million, you have access to stocks, bonds, mutual funds, ETFs, things like that. I think the challenge with that is that you don't really have access to the best and most sophisticated asset managers out there.
Right.
It's really the institutions that have access to those most sophisticated asset managers. But that comes with being able to cut checks of 100, 200, 300 million bucks.
For sure.
And so our idea was that we could use our experience in the hedge fund space, decades of experience having actually been in the biggest hedge funds in the world, take that understanding and build technology that actually allows us to look over the shoulder of what hedge fund managers are doing in close to real time.
Yes.
Take that, package it into securities that basically make those returns available to everyone, because we're using technology instead of paying star PMs 2 and 20. We can do it at a much lower cost and put it in structures like ETFs or other structures that are available for anyone, whether you've got $10 or $20 million.
I'm assuming there's a downside to running a model like this, which is a low fee model, because I'm assuming that if it was like very profitable, a lot of other people would have adopted this. So do you feel like that's the direction that the industry is going to head to, this kind of low fee model, or do you think that this is going to be a niche thing for certain, newcomers to be able to introduce?
Well, I think it's a good question. If you're an investor, what do you want your manager to look like? Do you want them to be sitting in a Spartan office in the burbs, right? Small Spartan office, or do you want them to have a glitz and glamour of a perfect office building on Fifth Avenue?
Option A.
Option A
every day.
Right, and I think that's
Yes.
part of the story is that people they're focused often on the wrong things. They think that the glitz and the glamour and the expense is the thing that identifies skill, when it's the exact opposite.
Because it's a distraction. From doing the actual work to have the competence. Right?
That's exactly right. And so I think part of the story here is with the low fee model is that over time you should expect that to outcompete the high fee model.
Of course.
Because what investors care about in the end is they don't care about how much money the manager makes. They care about their net of fees, net of taxes,
risk, and then returns.
Exactly. That's exactly right. And so that's what they should be focused on. And the whole system is very inefficient. If you just think about it, there's still trillions of dollars of actively managed mutual funds out there that suck.
Yeah. So you say they suck, they're underperforming just like an ETF?
That's right. They're charging 150, 200 basis points, sometimes even higher than that.
Wow.
And they're delivering, below benchmark returns. And so, but literally trillions of dollars of assets are in there that advisors have directed capital into there, in part because they're incentivized to direct capital into those, in part because there's a legacy problem. Those products were invested in years ago and are still available, and that's not good. That's not good for the everyday investor. The everyday investor needs more access at a lower cost. That's what the everyday investor needs, and that's what, if you're really solving the needs of the everyday investor, that's what you're focused on: more access, lower cost.
So there's so many questions I want to ask here. So we've seen a case study example of this with Fidelity and Schwab, and some of them who have introduced lower fee structures and kind of created an ETF. I think a very interesting statistic is that when you look at the performance of hedge funds, they typically underperform the S&P benchmark. This is kind of like the bet the famous bet that was made. So what can investors or what can the viewers take away from that data point, which is that a lot of the mutual funds that and the asset managers and the hedge funds are underperforming just an S&P benchmark? What is a takeaway that people can have from this?
Well, I think there's two main takeaways. The first is that it's hard. It's hard to generate alpha over time. I've been in the business for more than 20 years. I know what it takes to build sophisticated asset strategies that are able to consistently generate positive returns in excess of the benchmark. And so I think what that highlights is no one should take casually the idea that they're just going to generate good alpha. You might get lucky in generating positive returns or unique returns, but to do it well means discipline, skill, hard work, day in and day out. It's not impossible, but it's not a casual activity that you're going to generate those things. I think the second thing is that the fees are too damn high, and that's all there is to it.
Yep.
A lot of these managers, if you took away the fees, if the fee was zero, they generate plenty of alpha, right? So hedge funds at 2 and 20, right? If you took away the 2 and 20 fees, they actually generate a fair amount of alpha. Hedge fund returns without those fees are generally better than the S&P 500 with half the volatility and a third of the drawdowns, and are not, are lower, have low correlations to things like stocks and bonds. That's a pretty good asset. The problem is they take all that alpha away from fees. It's the old story, where are the investors' yachts, right? They're gone from fees.
Wow. Okay. So the reason that people will pay the high fees to a manager is because they get convinced that they are not sophisticated enough to navigate financial markets. Now, that's kind of an outdated idea because of the access today. So how do you see the access having changed? And do you think that people have a better chance today of being able to do it themselves?
Well, I think the everyday investor has so much more access today to sophisticated tools and also to being able to access the markets themselves than has existed, in decades. And I think that's really neat, because what it allows folks who otherwise would be locked out of the professional asset management world to be able to gain the skills and also have the ability to actually get in there and trade the markets, on par with people who are trading the markets in the largest institutions in the world. And what's neat about that is it's democratization of the education, so that anyone today. Look, if you got a computer and you can go on YouTube and you can
follow Bob Elliott on X,
exactly.
you can get a real quality education.
I mean, it's incredible what's available. The sort of things that honestly, when I started my career, were only available to a very small select set of institutions are now increasingly available for every investor. But what I would say is what that doesn't skip, though, is that you to make use of that and to succeed, that you still have to do the hard work.
Put in the work.
You have to put in the work. There is no shortcut to success than putting in the work and being disciplined and showing up every single day.
That's incredible. What skills were you able to transfer from your time at hedge funds to kind of doing things yourself? Were there any skills that didn't transfer over and you had to kind of think about investing differently or macro differently, or was it the same game, just in a different scale?
Well, I think a lot of the core sort of fundamental principles of how markets work and how to think about markets are highly applicable. And then, in a lot of cases, what we were doing, what I was doing there was building proprietary investment strategies. And what I'm doing today is much more taking my understanding of how managers create those strategies and then trying to understand how they're positioned as a result today. Sort of drawing on the wisdom of the crowd, so to speak, right? And so, in some ways, that skill set of drawing on the wisdom of the crowd is informed by that experience. But actually, a lot of the stuff that I'm using in building our technology today is totally different from what we were doing before. I think it's interesting. A lot of people talk about the sort of AI revolution. AI, large language models. That stuff's not going to pick stocks anytime soon.
Sure.
And there's good reason to believe that because there's not enough sample size, and in general because it's not refined enough to be able to do that effectively. But those tools and techniques actually are very good at observing what managers are doing.
And kind of assisting managers.
And assisting managers in figuring out what the right direction is. And so actually a big part of what I've learned incrementally since I left was a new suite of AI and machine learning tools that I wasn't really using previously.
So I'd say, and I don't want to kind of go on this too much, I do want to talk about the future as well. But I'd say Bridgewater and Renaissance were the first to really implement AI as a assistance mechanism for analysis. Can you, without giving any proprietary info, can you just talk about generally how that AI was helping in your investment decisions and how the evolution of that kind of where we are today?
Well, I think the novel approach that a lot of those funds brought to the table, starting really 20 or 30 years ago, was this core idea of systemization. And so if you go back 20 or 30 years ago and you talk about macro, what did people think of macro? Macro was taking huge bets, trying to break the pound, something like that, right? Huge discretionary bets made by savants. And the reality is it's very hard to make money in markets as a savant, unless you're incredibly
Unless
lucky.
you're a savant.
Unless you're a savant, right? And so one of the key questions was, how do we go through a process of, if you want to be an asset manager and you want to have more reliable outcomes, right? Because if you have just one or two concentrated huge bets, luck is a big part of the story.
Of course.
And so how do you create a more reliable approach? And systemization was just the way to do that. In a lot of ways, systemization was just this idea of there's sort of these rules that people have in terms of thinking about, do I want to buy a stock, or do I want to buy a bond, or do I want to buy a currency? What are the 10 things that you think about when you're thinking about that at any point in time? Well, instead of just rethinking about it every single day,
you have to have a framework.
Right, just write that down and then get that processed, and then at least you have the first 10 things you've thought about, and then you can think about number 11 and 12 and 13.
So it's repeatable and it's predictable?
Exactly. And part of the thing that I think often gets overlooked with systemization is discipline. One of the biggest challenge in asset management is not understanding how to beat markets. That's not the biggest challenge. There's actually lots of ways to beat markets. The biggest challenge is the head game
of staying consistent
and reliable in following your game plan. That is the hardest thing with markets. And so systemization is a cheat code to doing that more reliably.
God, that's so good. Okay, if an extended, and I'm going to shift topics, that was so good. If an extended, because it relates to trading as well, which is if you want to have a positive expectancy system, you have to systemize your approach.
That's
and
right.
that kind of discretionary random approach or intuitive approach doesn't create repeatable results. So I'm really glad you touched on that. If an extended family member called you and said they either wanted to go into stock picking and kind of finding individual investments, or just to get into a ETF, what would you advise them?
Well, I think for managing money, I often say it's a full-time job.
Yes.
And so, and that could be no matter sort of what approach you're taking. You could take a technical approach, you could take a systematic approach, you could take a discretionary approach, but you can't casually try to beat the markets. It doesn't work.
So you're saying there's no passive approach?
No, what I'm saying is that if you're trying to beat the markets, that's a full-time job because you're competing against the smartest, most sophisticated asset managers in the world. If you're trying to invest, if you're trying to build a savings portfolio, that's a whole different story. There, your ticket to success is to not get too enamored by the shiny thing and build a, frankly, boring, diversified portfolio that is consistent with whatever your risk tolerances are.
Of course. So in Ray Dalio's Principles, he talked about an all-weather approach that's basically a way to navigate the unpredictable, right? Because you don't know what's going to happen, and so you have to kind of risk weight your investments based on their risk. Do you have a similar approach to the way that you were approaching like the assets that you add to the ETF, or do you have slightly different? And without giving away proprietary info, but Is it a similar approach?
Well, I think for when we're trying to replicate what hedge funds are doing and how they're positioned, what we're really doing is following what that wisdom of the crowd is. And so sometimes that's a balanced approach to different assets, and sometimes that's concentrated in certain areas depending upon what's going on with, where there's value in markets and where there's not value.
And that's your discretion. That's where you can add the value and find opportunity.
Well, I think that's where alpha managers find the opportunity. Yes. From what we're doing, I'm actually not. I'm not generating discretion. I'm not using discretion in our replication of their approaches.
Okay.
And I think the reason why that is, it's important when you're an alpha manager to have some humility. One of the things that's really interesting is if you look at hedge fund managers in general through time, what you see is that managers, if you take the whole universe of managers, they're smarter than the market, right? They generate alpha in aggregate over time relative to the market. But any individual manager, their outperformance of the manager cohort is not persistent. So what that means is the wisdom of the crowd actually has a lot of insight, but any individual manager is somewhat random around that wisdom of the crowd. And so one of the interesting things, if that's true, is if you want to build the best possible hedge fund strategy portfolio, you're better off creating a diversified portfolio of managers rather than trying to pick.
Wow.
Now that is a statement that offends many in the halls of the allocator community, but it's the reality. And so part of the reason why I'm drawn to that sort of work and replication is because it's a better way to develop a diversified alpha portfolio than what most folks are doing out there in the market today.
Okay. So I'm guessing the main point is that it's really hard to beat the markets, so you're better off riding the wave as opposed to trying to build an alpha portfolio. But if you want to be an asset manager, understand how complicated the game is and how much do you think that like the performance on aggregate is being weighted by the top 5 performers and everybody else is kind of underperforming?
It's not. That's the thing that's amazing. Amongst the alpha managers,
there's
no manager outperformance persistence.
Because in the venture world, that's actually how you see the top 5 venture funds having outsized returns because they're invested in unicorns. Then you see like the next 90 that are underperforming. And so you're saying it's not a similar thing. It's just more of a random distribution.
It's a random. It's a function of luck, not a function of skill. And if you look over time, I should say, not the aggregate performance. The aggregate performance has alpha.
But the individual.
But the individual relative to the benchmark, that is a function of luck, not a function of skill.
So as somebody who's an aspiring asset manager, how am I supposed to look at that in an optimistic way and say I can build a repeatable approach if you're telling me that there's this much sort of luck involved?
Well, I think
generating alpha.
The first thing to recognize is there is a lot of luck involved.
Okay.
And I think that's really important because what that should do is that should give you the humility. Luck can be good for you, and you can look better than the reality and get overconfident. So when you're on the path, when you're on a streak of winners, you should check yourself a little bit.
I like that.
Because that may not be the reality of how good you actually are. And the last thing you want to do is double down into a more difficult period of time.
And give back all of the gains.
And give back all of your gains. And that is the biggest risk. The biggest risk for most folks starting off trading markets is that they are successful early. Now that is a crazy thing to say, right? But the reason why that is if you're successful early, then you don't have the humility of recognizing that you might be wrong. And what that range is, you need edge, right? And you could probably have edge. But that edge is only so good, and it's almost never as good as when you're on the hot streak.
Of course.
Right? And
so everyone's a genius in a bull market. It's until tide rolls up. I mean, as traders, I think we've all gone through this because maybe we joined some program where there were profitable signals, and at the beginning you have this unrealistic expectation. And then the issue that I dealt with was kind of like chasing a high. So like the easy money that comes off the first 5 trades, and you're like, $500 to $5,000. I'm going to become the next I'm going to crash the pound. So what I love what you said is that you should humble yourself before the market humbles you.
Right.
Because it's a lot less painful to self-check rather than the market to give you a reality check, right?
That's right. And I think you can always tell a person who's really traded markets for a long time because they have you'll pull up a chart of a market and they'll have the scars. They'll be like, I remember
This trade.
this trade at this time, and I got hammered on it. You know, and for me, I was lucky because when I started out, I in the 2000s, I thought I should trade natural gas. And why trade natural gas? Not because I knew anything about it, because it's the most volatile commodity I could trade. And I lost my entire first year bonus on trading natural gas because I didn't have any idea what I was doing.
This is Desert Storm era?
This is yeah.
Wow. So it's the most volatile period for nat gas.
Right, exactly.
And that was your
And I
first
was like,
experience.
I should trade natural gas. And you know what happened is I made a bunch of money in the first, few months, and then gave it all back and then some through the rest of the year.
Yeah.
And it was the best money I've ever spent in my life because I said, wow, this is a lot harder. This takes a lot more discipline than just, gambling.
Yeah.
Right? And that you got to get your mind out of that story. This is not gambling and the high of winning and thinking that you're the most successful person that's out there and you're more skilled than everyone else. Like the most successful asset managers in the world are humbled every day by the asset market, so should you.
Nice.
But it also doesn't mean that you can't generate alpha over time if you stick to a strategy that can consistently generate alpha. It's not just all winners. It's not like just clipping coupons on a bond. There's ups and there's downs and there's noise, and so you have to have the discipline to keep playing your edge over and over and over again, and not get too extended on any one trade, at any point in time. And basically give yourself the most bets that you possibly can. It's like counting cards at the table, right?
If you're betting too big on any individual hand, couple hands and you're bust.
You're going to wipe yourself out. But what you want to do is you want to bet enough.
Give yourself a cushion.
To give yourself a cushion to be able. If you're doing this well, you're trading markets 30 years later, right? That's the goal. If you want to have that in your mind, that's the discipline that you want to have in your mind.
That's incredible. It seems like the recurring theme you keep talking about is a perspective of the reality of the game, the nature of the game, the uncertainty of the game. And if you can be successful, but you have to accept the nature of the uncertainty.
That's right.
And the people that seem to struggle the most expect some kind of certain approach. Like there has to be a mechanical system to it. And really, the uncertainty is really where alpha managers thrive because you can accept, I guess, the anxiety of uncertainty.
Well, I think a big part of the sort of quiet reason, the often not talked about reason of why many asset managers can be successful over time is that they control their risks really well, right? So, take a bunch of managers that have the same edge in the market, right? Some that are very good at risk controlling, controlling their risk and not taking too much bet on one particular bet or, constraining drawdowns and things like that, and others that, get lucky on a roll and then get caught being overconfident. They could all have the same edge, but the one that's going to be the most successful over time is the disciplined, conservative, risk-managed player that is going to, that shows up every day. That's what you have to do every single day. Come in and play your edge and play it effectively in a disciplined way.
So would you say that the discipline and risk strategy is more important than the, let's say, investment system? Like how you pick stocks or like for us as traders, we have an execution criteria of what we're looking for. You would say that the discipline and the risk system to stay in the game longer outweighs the technical?
Well, I think in a lot of ways, yes. When it comes to trading, there are a lot of ways to beat markets. Lots of ways, right? I happen to, my sort of career has been systematic macro, but now I'm doing replication. But there's great people who have built long careers trading technicals, trading intraday, trading 10-year time frames, trading individual stocks, trading currencies, trading all, sectors, macro, all sorts of different ways to make money in markets, and lots of different ways to have edge, and that's the key thing that determines between success and failure is not do you have edge or not. It's whether you play your edge over and over and over again in a disciplined way. So there's lots of good ways, and ways, you and I might trade the markets totally differently and might both have edge over time, right? Relative to people who are essentially trading randomly or even with a negative.
But as long as we're consistent, regardless of strategy, you're going to be, right? Unless you have a failing system and you're consistently failing.
That's right.
But even that's an edge. If you just did the opposite, that's where I was for a long time. I said, what if I just took the opposite? I was an 80% losing win rate. I said, oh, this could be an edge here. So can you talk to folks about your, just a brief, because I know we talked about this on previous podcasts, but not in depth about your biggest takeaways at each stage of your time in investments. You've had so many different roles as an analyst, as actually putting on risk. What have you learned at every different role that you've had in institutional markets?
Yeah, I mean, I think early in your career, there's this rush to be to get into markets and to try and prove yourself to be a trader. And I think part of the story there is it's not something that you learn in a book, right? It's not like you read a textbook and then you go, yeah, like I'm trading, right? You know, too many people out of college think that that's the way it works, and instead. I think early in a career, it's much more about how do you set up the path, the discipline, the approach that is the day in, day out to help compound your understanding of how markets work over time. And so that's where, I think early in a career, getting into the mode of, every day coming in, looking at markets, trying to understand markets, engaging with and reading the best people who are out there thinking about what's going on in the world, and constantly sort of challenging yourself to build that understanding. I mean, it's still today, I write a bunch of stuff on Twitter, like every morning I basically write something. And the reason why I do that is not, in many ways, is not, it's not because I'm trying to get some Twitter following, as a simple example. It's because that's the approach that I've done for 25 years that has helped me understand what's going on in markets. Come in every day, look at the markets, try and understand what's going on, write down your thoughts, put them out there, and then,
go back and review after and what's amazing is I've seen you do it when there was 3 people liking the post,
right,
and when
exactly.
there's 3,000 people. That's what I love, because I know that it's true to your system. It's not something that you're trying to do to get, because that's why people are not consistent on Twitter, because they're doing it, they exhaust themselves having like a 3-month stint where they're really trying to put out content, but it's not part of their routine.
It's not.
So they have to force themselves to do it.
Right, and I think the people who are, I mean, this, you must see this too, the people who are most, the social media world is very good at determining who's an authentic person there, trying to represent, just in, out there engaging in a community, and those people who are trying to produce a bunch of stuff and get clicks and stuff like that. And particularly FinTwit, I'd say, is very aware of
you got high sensitivity,
whether you're one or the other.
Yeah.
And so, but that's a simple example. That's a method for me is writing. I wrote hundreds of the Bridgewater Daily Observations that basically every day was coming in and writing something incrementally, and that's the way that I built my ongoing understanding. Look at the markets, think about what's going on, write down your thoughts, trade the markets, put that down, get feedback. Come back next day.
Yep.
Are you right or you're wrong? Look at the markets, understand what's going on, write down your thoughts, put on the trades, get feedback, and that's the cycle. That's the most important cycle, and you can't short circuit that cycle.
Yep.
Right? You have to come in with that every single day, and that the thing about that is it's the difference between the sort of soft way of doing that, the casual way of doing that. Let's say that compounds your understanding at 5% a year versus the disciplined, serious way of doing that compounds your understanding at 20% a year. And the difference between compounding at 5 and 20 is the difference between being successful and not successful.
Yeah. Or if you're around such a high quality environment like you were in, it's probably a lot higher.
I mean,
to be completely honest, it's exponential.
Yeah, I was very, very, very lucky. And during a time, particularly, before the financial crisis and through the financial crisis, that I think was one of the most interesting times in markets, although, probably if you talk to anybody who's been in markets long enough, they'll say the time that they started was the most interesting time.
Well, didn't Peter tell it was in the 1987 crash?
Because
I asked him to kind of thread the needle between 87, 01, 08, and 2020 because of, how things have changed. There's people passing out on the floor of the exchange in 87. But like you said, it's like the one that has the deepest impact is the one where you were fresh. Now, it's easy from this perspective to say, you have to be disciplined and you have to have this approach. When you were winning in your first experience there, and the boardroom was like, oh, this guy Bob is the next guy, and you kind of have this like a little bit of a drop off. How were you getting yourself back mentally in the game? Did it affect you, your confidence at all, or not?
Well, I think part of the way to approach that is to is if you have enough different positions or enough different trades or things like that, you don't want to get overly enamored in one particular view or time, one particular market, right? And so that's part of the way to conserve yourself, because as an example, if your edge is 60-40 or 55-45 and you got 20 markets on, you're going to have a few winners, you're going to have a few losers.
Sure.
And I know that it can sound like chaos to do a bunch of different trades at the same time, but it also is helpful in keeping yourself disciplined in the mental game. Because like the worst case you're going to do, in a terrible case, maybe you're down, you get 40 or 35% right and you lose, 60 or 65% in that sort of setting. So that's one way to kind of approach it. The other is, again, it being a head game. I think one of the hardest things is getting yourself away from the idea of what the markets say in a day-to-day is
correct.
Is a reflection of your
ability.
Your ability, right? Markets are, there's plenty of noise in markets. There's plenty of randomness in markets, right? And so instead thinking about markets and the feedback loop as a way to learn and a way to ask more questions, and instead of a right or wrong, you are good or you are bad, right? There's something to learn, something you didn't understand and something you did understand. That's a growth mindset to the feedback. I think it's a hard mindset to have, because I don't know, our educational system is about is the answer right or wrong?
Yeah.
And I will tell you that I've been more wrong in my career than 99% of people in markets. I've been more wrong.
As of most successful asset managers, though.
That's right.
Yes.
And most successful asset managers have been more wrong because they put on more bets and they've gotten them more wrong more times, and they've learned more.
I saw statistics, something like Kobe had the most missed shots in NBA history or something, and he was one of the greatest players of all time.
There you go. That's great.
Because the championship level is about the trial and error. There's no perfection, because perfectionism leads to hesitation, and because there is no perfect trade. From what I'm hearing from you, is you have to have a diversified portfolio, so you're not overweighting any one trade. It's like this one position is life or death. Right.
That's right. And it's hard. I wish I could give people the key to how do you transition from a right-wrong mindset to a learning mindset. But that is the difference. I have seen people who have much better, let's say, academic credentials, much higher IQs with bad approaches, with right-wrong approaches, and people with much worse academic credentials and much, and people who, on the IQ test may not be scoring nearly as high, who are way more successful because they're much more learning oriented.
Yes.
Learning, hard work, and discipline oriented.
And humility.
And humility, absolutely.
What we found from coaching traders is that the folks that come from strict disciplines where there is a right or wrong, so if you're in medicine, engineering, or law, there is one answer to this solution.
Right.
And they kind of expect they have the same expectations coming to markets, and that's where they struggle the most. And like you said, Warren Buffett said, if you have too high of an IQ, leave some points at the door.
Right.
If you're going to be an investor.
That's totally right.
Because when I was learning to trade, some of what I would say the most simple approaches, and the folks that really they didn't even know a lot of the things happening outside, because they were so in their system and in their bubble, that were having the most success. And I asked one of them one time, and he said a funny joke. He said, "I is rich." He said over I am right, or something like that, or I am smart. And that changed my life when it came to
no, it's totally right. It's totally right. It's I think one's academic experience and credentials are not particularly good at indicating whether you're going to be successful at trading markets.
I got a finance degree. We're still learning efficient market hypothesis. That was 2020. So let's shift over to macro.
Yeah.
So I know that you have a bit of a contrarian approach right now, or a contrarian outlook on the state of the economy. It's doom and gloom if you look at the mainstream networks. But if you follow Bob, you see that the labor market is stable, and you see that the economy is on what I would say a sustainable path towards a soft landing kind of environment. What's your current outlook, and how do you feel like that differs from the mainstream right now?
Yeah, I mean, when you look at what's going on with the U.S. economy, I think it's a cycle that we haven't seen. Most of us haven't seen in our professional lives, and what that cycle is it's what I call an income growth driven expansion. And so while there was COVID, and then there was the fiscal expansion and transfer payments associated with COVID that helped create the rebound after that. That stuff has largely tailed off and stabilized. And what's happening now is that people, unemployment in the U.S. economy is basically at secular highs. Unemployment's at secular lows. People are earning income, right? Their income is growing at 5 or 6% a year, and they're taking that income and they're spending it. And they're not generally borrowing. Doesn't mean that there aren't certain pockets, of distressed credit card borrowers that are borrowing. But I'm saying in the economy, if you're a middle class, let's say a normal middle class family, you have a 2%. You own your home, you have a 2% mortgage, you got a few $100,000 in your 401k, and you're employed, and your income's growing at 5 or 6% a year. That's the core of the U.S. economy, and that's the type of economy that exists, like in Cleveland. Maybe not in New York and San Francisco,
right.
Totally different world. But in Cleveland, that's the story of the middle class family, and so that is actually a very sustainable dynamic, which is as long as you're basically spending in line with your income growth, your spending growth is in line with your income growth, you can keep doing that forever. And because one person's nominal spending is another person's income, that's a very positive cycle that's going on in the economy. It's very
Except, oh, sorry, I didn't mean to.
no. I say it's very similar to the types of economic expansions that happened in the 50s and the 60s, and very different from the types of economic expansions that happened, say, in the bubble period in the in the late 90s and 2000, where there was actually a lot of corporate spending that was supporting corporate borrowing that was supporting the economy, or the housing boom and bust, where households were borrowing a bunch of money, or an environment which was very money driven in the post GFC period, where the Fed basically pumping money into the system was primarily driving it. It's a totally different cycle that's going on.
But there is, so I would say there's one overlap, great breakdown by the way. I would say there's one overlap, which is the double-edged sword of the wage inflation problem, which is that as wages rise, so does inflation. And that one person's wage inflation is somebody else's price inflation. And so that's been what I would say is one of the bigger problems, even though, because Jerome Powell has expressed that the supply chain dynamics that he was sort of crediting to the inflation crisis have basically smoothed out. And so the only thing left that's keeping inflation sustainably high is the employment being strong and wage inflation. So how can we get inflation meaningfully back to 2% without taking a hit to unemployment? Or are we still in the same crisis?
Well, I think structurally, a lot of the hard work in terms of bringing inflation down has happened, but we're not there yet. Measured inflation is still running at 3%, and I think most people, certainly on Main Street, would say that inflation, the reality of inflation is higher than 3% a year.
For sure.
So it's certainly still front of mind, and I think it's an important reason why what we're seeing is those negotiated wages are a bit elevated relative to where they were pre-COVID, because that inflation problem continues to exist. Labor markets are tight, and people are still feeling the pressure of inflation. And so what you have is, given the nominal income growth defines nominal spending. And so the question is, how much of that is real, which is good, considered good in the economy, and how much of it is because of price growth? And the difference between essentially your income growth and your productivity growth is what defines what happens in inflation. It's, at some level, it's a very simple thing, which is like...
But it's like a chicken or the egg. Which one comes first? Is it people are getting paid more, so they're spending more, or is it because prices are higher, they're negotiating their wages?
Well, I think that's one of the challenges of this macroeconomic cycle. The answer is both. and I think it's one of those things. If you had grown up in an emerging economy with domestic inflationary pressures, when I say both, it would be obvious. Like, the people who grow up in those environments would say, yeah, of course it's both. Yeah. And it's reinforcing, and it's a dynamic. It's not a static, linear thing. But here in the U.S., most people in their professional careers have had a world where we've had only 2% inflation basically for their entire lives. So
14 years of an expansionary environment, and that's the
that
expectation.
Has low inflation, and so they just sort of think about it in a linear way. And that's not how these sorts of dynamics work. And so they are self-reinforcing in that way. And I think what's happening is we're settling at a point where that gap between in nominal income growth and productivity growth is too high to achieve that 2% inflation mandate. So how do you deal with that? You basically have to have one of two things. either we have to have income growth moderate, or we have to pick up productivity growth. And both of those things are plausible solutions. I think we've had a bit of a benefit over the course of the last, let's say, 12-ish months, 12 to 18 months, that actually productivity has been a bit of a benefit.
Yes.
And that productivity benefit has come as supply chains have improved. And that's a good way to resolve the inflationary problem. But the question is, can it be persistent? Can we continue to get productivity growth as strong as we've seen in the last 12 to 18 months? From a longer term perspective, that probably, that's not, productivity growth recently has been much stronger than the longer term perspective. So my guess is we probably can't resolve the inflation problem because we probably won't resolve it through productivity, but you never know.
Or some combination of both.
Or
so
some
maybe
combination.
like AI tailwind comes in. We have some, because the exponential effect of AI is like the tech revolution, on steroids. Because of, you can cut down costs when it comes to corporate overhead, and you can increase your productivity by 100x or 1000x in some cases. So I mean, maybe there's a little bit of hope on productivity, but they tried to pin Jerome Powell down at the last press conference about a specific unemployment number that would trigger a Fed response. So at what point is the unemployment situation so severe that now your priorities have to shift from inflation back to maximum employment? And Jerome Powell's answer was very interesting. He said, we're going to expect some hit to unemployment. And so we're already baking that in, and we're not going to step in. And they tried to say, okay, well, at what level will you step in? And that's where Jerome Powell gave his usual answer.
Right. His usual
How do I dodge it? Let me just go page 85. Yeah, I can't answer that for you. So, okay. So what do you think about that? What do you think about the fact that he's expecting some hit to unemployment, and so that's no longer a proxy for a potential Fed pivot and not a reliable signal anymore? Do you agree?
Yeah, I think in sort of a macro sense, what the Fed's trying to do is keep unemployment low and bring inflation back to their mandate, and that's generally what they're trying to do. And I think a lot of what we're discussing here is sort of the marginal trade-off between those things. If we look at what's going on right now, unemployment's been below 4% for 18 months. It's basically been flat for 18 months. That's quite good. That's quite good employment conditions. Yes. And inflation's been too high for a long time. And so I think part of what the Fed is wrestling with is, look, we've got a in general, a pretty good environment on the employment side. Inflation that's a little too high, and I think an external environment that is concerned about about the Fed maintaining monetary policy that's too tight for too long, right?
Yes.
That's certainly an influence. And to be clear, that is a normal influence. If you go back and read Fed minutes from 1965, it's the same exact story. People think this is some sort of new sort of political influence on the Fed. Every single time the Fed is running relatively, elevated monetary policy, people are complaining that it's too tight.
Of course. Everyone would always hope for looser conditions.
Everyone wants, everyone wants looser conditions, unless of course you get inflation and it's destabilized, right?
Yeah.
Main Street actually doesn't want, loose conditions that lead to inflation because because the inflation is most impactful, particularly on lower income cohorts.
Yeah, because they don't own assets.
Because they don't own the assets.
So they don't benefit from the asset inflation, but they get hit with the consumer inflation.
With the price inflation. And so I think that's a challenging thing for the Fed to sort of weigh all those different things. And I think basically what their view was, coming into the year was to say, look, if inflation really is coming to 2%, then that gives us a little bit of room to bring interest rates down. We can get some confidence to bring interest rates down.
But they just don't want to do it too soon because they feel like it'll exacerbate the problem again.
They don't want to do it too soon, and I think the challenge that they have is that some of the information that we've seen since the beginning of the year has run counter to the inflation moderating to the Fed's target. So we've seen measured inflation pick up, and probably even more importantly, what we've seen is a big reversal in oil and gas prices. So part of what put the Fed in a good position at the end of last year and early this year was that gas prices went from $4 to $3 on a national basis. Now we're back up on a path to $4, based upon tradable gas prices. So we went from a nice disinflationary force in the economy to an inflationary force in the economy.
Yep.
Plus, measured inflation has picked up a bit. So you put that whole picture together: strong employment, strong economy, inflation pressures picking up. And to go back to your sort of opening question, that combination of things looks more on the path of no landing right now than it does look like on soft landing. And a no landing path is a path where the Fed doesn't deliver the cuts that have been expected in the market to kick off the year.
Now, because the market has been pricing in these cuts, which is why I feel like we've seen such an aggressive run on equities, do you think that the realization that we're not getting a cut is going to have that adverse effect where the market's going to have like a wake-up moment, have a big sell-off to sort of protect? Or do you think that there's enough optimism and enough stability that they're just going to keep the game rolling and sort of just keep the risk on sentiment?
I think when we were coming into the year, there was real concern that the U.S. economy was going to slow meaningfully. I mean, analyst expectations of U.S. growth over 2024 coming into the year was something like under 1%.
Oh wow!
So part of the equity rally that we've seen in 2024 has been a function of recognizing that actually conditions aren't slowing anywhere near as much as what's been expected.
Okay.
And part of the pricing out, we came into the year and the Fed was priced to cut 7 times in 2024. Part of the pricing out of that has been a recognition that the economy is much stronger.
Okay.
So we've gotten stocks up, right? Interest rates have risen, both on the short end and the long end, as a function of that recognition. But now we're in an interesting and I think challenging moment, is that at this point, expectations have actually shifted a lot. Whenever you're trading markets from a macro perspective, what you're doing is you're trading what's going to happen relative to what's priced in. What are expectations? And that's very important. Everyone often forgets, they say, well, growth is strong. Who cares if growth is strong? What matters when you're trading the markets to the return of the asset is how growth comes in relative to what people are expecting. Because what people are expecting is already in the price. That's probably one of the most important things in markets.
You told me that that's what edge is. It's the distance between what the market is pricing in and what you believe to be the true value.
Yeah, what will actually transpire. And so I think one of the things that we're faced with today is the fact that, for instance, in the equity market, it's reflective of strong growth in the U.S. for an extended period of time.
Okay.
Right. So we've now moved from under 1%, expectations of growth in 2024 to now 2.5% expected growth in 2024. That's a radical change. That's in the equity price that you see. When equities are at 52.60, that is based upon that expectation. Now the question is, are we going to be able to realize that amount of growth in an environment now where interest rates have risen? And so that, I think, is probably the most interesting point there. I think the equity market reflects the stronger growth in the economy.
Yes.
The bond market, particularly the long end of the bond market, isn't quite there. There's more room to increase on the long end of the bond market. And that will have a feedback effect on the equity market and on actual growth conditions. And so we're in this interesting period, and I think markets in general are in this interesting period, where we had sort of extreme expectations in one direction. The economy comes in better than that. Now we've moved to relatively extreme expectations in the other direction. That then sets up an opportunity for a reversal. And that's really what we've seen for the last couple of years, is these waves of relatively extreme expectations, either too positive or too negative, when the reality of the macroeconomy is very different than what you'd read on Twitter. The reality of the macroeconomy is that it doesn't move very much.
Now, and if I could challenge you on that, I would say that over the past 2-3 years, we've seen a lot of speculative activity as opposed to pure fundamental investing. But what you're saying is that the largest players, or like at least the market movement, is being driven by this expectation of real economic growth, and then we've seen GDP obviously outperform. Do you think that markets are reacting to the true fundamental nature of how stable the economy is, or do you still see some speculative nature to why it's, we've seen such a big hype?
Oh, well, I think in general, I think the rally in equities over the course of, certainly in 2024, I think it's less extraordinary than I think probably, people talk about bubbles and stuff like that. Look, people thought growth was going to be weak. Growth was stronger than people expected. Equities rallied 10%. That's, pretty normal stuff, all things considered, right?
Yes, sir.
And, you might say, well, the valuations are a little elevated, but, there's a variety of different reasons why that might be the case. And frankly, trading equity markets on valuations over a time frame that any trader is thinking about is pretty useless. Like valuations don't really matter. What really matters generally is expectation. What actually happens in the course of 3 to 6 months relative to what the expectations are for those 3 to 6 months. In some ways we've had a largely reasonable and at least actually when I started the year, I said, look, I think stocks are going to outperform bonds meaningfully over the course of the year, and that's largely what's happened. And I think that was a very rational outcome of what the macroeconomic realities were. The thing that's interesting about the sort of speculation in the market is that really in the last couple of years, there's a lot of focus, I think, on trying to call turns.
Pivots, yes.
Trying to call pivots. And what's interesting is in the environment, particularly the QE environment, the post-GFC, what actually created turns in the economy was very trendy. Or I should say the economy and markets were very trendy. They'd move, the Fed would ease and markets would move up. And then the Fed would withdraw stimulation and the markets would move down. And we sort of went through a bunch of these cycles. And what they sort of told you is if you could find the leading indicator, the thing that sort of told you a turn was happening, it would actually put you in very good shape to then position for the next move down.
And be ahead of the
be ahead of it. But the thing that we've seen in the post-COVID period is actually the Fed is pretty inept at impacting the economy for all sorts of reasons around why, interest rates have been less impactful, particularly on the short end, than have existed, in previous cycles. And so the result is, let's just say the regime is very different, which is the actual macroeconomic regime, the actual story of the economy ain't changing much.
Yeah.
It's just kind of meandering along. Like, I'll show you a chart of the unemployment rate and it'll be boring, right? Totally flat.
And that's why people create narratives, though. They're going to kind of keep the day-to-day hype
and
alive.
And then what's happening is people are like, oh, well, SVB is going to bring down the economy. And it's like, no, AI is going to create a boom. And it's like, no, Fed tightening is going to bring down the economy. And so we've seen, people are too focused on trying to call the turn.
Yeah.
And the real advantage, particularly in the post-COVID period, has been consistently saying, what is priced in, what's likely to transpire, and there's been these huge gaps that have existed over and over and over.
And then trading that relative difference.
And then just trading that on a relative basis. That's
incredible. Okay, well, I don't know how you did that, but you read my mind on the next question because you mentioned bonds. And if we're going to talk about the stability of the economy, I think we have to mention quantitative tightening, which the idea was to start taking liquidity out of the markets. Now, because of the bank failures, we introduced the Bank Term Funding Program and other liquidity measures and basically undid the QT in the span of months. Do you think that the inability of the Fed to have undone the huge amount of QE4 that they did as a response to COVID, what are the after effects of that? And how significant is that?
Yeah, I think we don't have a great sense as to all the second and third order consequences of having created so much liquidity. On the margin, the fact that the Fed has been reducing the size of their balance sheet has been a bit of a drag on overall asset prices. But the reality is it hasn't been big enough to influence some of these larger macroeconomic drivers. It's just been kind of sitting in the background, just kind of plugging away, just not a big enough deal. And if anything, what's been a much bigger deal has been the Treasury and the debt profile and issuance of the Treasury, which has basically taken taken monetary policy, which is typically done by the Federal Reserve, and put it in the hands of the Treasury, where they've gone from periods of issuing, the U.S. is running a pretty big level of deficit, but there's been a lot of volatility in terms of how many bonds they're issuing. Part of it was because there was a debt ceiling issue, and they couldn't issue a lot of debt, and then.
But that's money printing now. Essentially, is that the creation of bonds out of thin air, and then the creation of money out of thin air. It's sort of like a trade between the Fed and the Treasury. Right? It's kind of like the back end.
Yeah,
mechanics.
I mean, it's just if you think about it this way, when you issue a bond, right, you're selling bonds, which means you're selling assets. Yeah. And so at some level, it's relatively, it's no more complicated than that, which is, in general, the U.S. federal government is selling bonds on a consistent basis, right? Because in general, they're running deficits. But if the volatility of their sales of bonds is moving around a lot, the Fed's volatility of their balance sheet is isn't really significant. It's just kind of meandering down, right? The Treasury's volatility in their balance sheet and how much they're issuing is moving around a fair amount because of a lot of these idiosyncratic factors and policy decisions. And so the reality is what the Treasury's doing matters a lot more than what the Fed's doing, and because of just the nature in which that volatility has happened. And it's very different in the pre-COVID period. Basically what happened, particularly with longer term Treasury bonds, is the Treasury basically just issued the same number every quarter. Because the Treasury's not trying to game the system here and trying to sell more here and sell less here and try and affect interest rates. It's not like the technocrats in the Treasury. I mean, these are like accounting nerds. That's they're like figuring out. That's what they're doing. They're technocrats.
This is a belief that there's no politicization in some of these agencies, and I guess it would be pretty tough to argue, especially with Janet Yellen's relationship with the Fed, the kind of common interests of the policies between the Fed and the Treasury today. Would you say that just because of common interest, they seem to be working in tandem in a way that might be inflationary or might create more problems down the line?
I think I'd probably separate it. The Treasury is a political institution.
Yes.
It's headed up by someone who is appointed by the existing administration, and it has in the sort of last
so was
couple,
the Fed chairman.
Sorry.
I'll let you finish.
In the last couple of decades, it has not been a big domestic financial system policy creator, incremental policy creator. It has, if you look over the course of the last 250 years, there are times in which the Treasury is implementing political policy through the way in which it's thinking about its debt profiles and engaging there. And we're kind of back to the future in that sense, which is what Janet Yellen's doing today in terms of having meaningful Treasury policy shifts, particularly in response to how they're seeing it in the bond market action. That is unusual for most of our careers, but commonplace over the course of U.S. history.
Understood.
And so she is a political figure in a political role, implementing policy. Now, there's a lot of speculation about the Federal Reserve and whether you think about them, how much you should think about them as a political entity. I mean, there's no entity in the world is apolitical, but my experience, I would say, and being pretty close to it, to the people who are there running policy and thinking about policy, is that the Federal Reserve is not primarily a political institution, and is primarily trying to focus on their mandate and trying to be, influenced by the data and trying to create policy around that data as much as they can. So I wouldn't primarily, the thought that like, hey, what's going to happen, as an example, is that Joe Biden's going to call up, Jerome Powell and say, ease the shit out of the economy so I can win the election.
That's why I say it's more of
that's not really how it works.
I would say it's more of like a common interest thing, which is why I kind of phrased it that way, because and this is kind of the common narrative, is a lot of this stuff is not some conspiracy of people in a room working together, but it's like-minded interest where there's just an unspoken understanding that we need to keep the economy stable in a year as important as this, and taking risky action by the Fed that could potentially hurt employment, for example, would be destructive to everybody. And maybe we should stay away from some of these more extreme policies and kind of stick to this path we have right now. Do you think that that's a factor? Or do you think that the Fed really does have enough, independence to be apolitical?
Well, I think we're already seeing it in the sense of there has been a divergence between the policies that the Treasury has tried to implement, implementing, which is much more politically oriented than what the Fed has implemented. Like, look, if growth continues to be as strong as it's been, unemployment continues to be where it is, and inflation continues to be a concern, the Fed will not ease, through to the election point.
Gotcha.
And they to be clear, they've said as much.
Yeah.
Right. And so if the Fed was predominantly pursuing growth stimulation, that wouldn't be their approach. Right?
Okay. I would say it's stability. So it's kind of like how when you have money, how you want to keep it, and so you're not taking any risks, versus when you're starting off, you want to take higher risk. I think because of the position they're in, maybe they don't want to take an action that could maybe be a better fix or a better path? Because this path is a much more predictable or much more safe.
Yeah. I think part of what you're highlighting is that if you look through the history of central banking, the first law of central banking is that central banks do a lot less than what they say that they're going to do. That's the first law.
Yep.
And it's kind of a joke on the inertia law of Newton, right? So that is, in general, central banks are very slow moving, and there's a variety of different reasons why that is. One is they're generally consensus-based organizations rather than voting. There's literal votes, but their decision-making is predominantly consensus-oriented. So what that means is you have to have a consensus. You have to convince the very last person, the slowest moving person,
Which takes time. It's like jury duty.
Exactly.
Yeah.
That's exactly right. And then on top of it, you're generally data-driven, and it just functionally takes time for data to emerge.
Like
right?
you said, there's too many fluctuations in the market on a day-by-day, which
so
is
they're
why
not-
the longer term.
Exactly. So
Okay.
what they're doing is they're taking lagged data. They need to see a fair amount of it, and then they need to develop a consensus around the policy that they're choosing. And so you put all those things together, and almost structurally, central banks are just slow-moving entities, and particularly in circumstances where there isn't an obvious growth problem, they're generally very slow-moving. Because if you're the Fed, really, what is the cost? If unemployment's at 3.8% and has been for the last 18 months and isn't really moving around very much, what is the cost?
You can just go and focus on your second mandate, and you don't really have to do anything else to really mess with it.
There's no reason to move. There's no reason to move quickly. And I think people too often think, for instance, in that two mandate system, the inflation and the growth, they think that the level of responsiveness to both is the same, and it's not the same. If growth is deteriorating rapidly, the Fed will cut interest rates rapidly.
Okay,
right? But if inflation is moving towards their mandate, that's great, but there's no urgency to cut interest rates.
So the only reason that inflation is on the front burner is because of how severe the current circumstances. Otherwise, growth and employment would be their number one priority.
Is the sort of thing that causes them to act with urgency.
Got you.
Right? When the financial crisis was happening, no one was sitting around going, wow, look at the inertia of the central bank. Ben Bernanke was like writing a new policy every single day.
Yeah.
You know what I mean? They were moving.
15% unemployment will get anybody moving.
Will get anyone to move.
Yeah.
And so I think
that's when the pitchforks come out.
Exactly. So I think but if there isn't any movement on unemployment, the economy's fine. There is no urgency to move, particularly in the cutting direction. I think it's mostly what we're seeing, whether it's with the Fed, but also what we're seeing even in Europe, which has technically an inflation mandate. They too aren't likely going to move all that fast because the economy in Europe, is like generally not fantastic, but it's also not deteriorating rapidly. Right. If it started to deteriorate rapidly, then they would start to move more swiftly to respond to that.
Yeah, I think just America has, the U.S. economy specifically had such a rapid growth that relative to the peak, it kind of seems like we're regressing, whereas other countries maybe haven't even had that big of an expansion, so it looks like they're more stable.
Yeah,
is that fair?
And I think part of the thing is.
And we have two last questions after this, so just
to
know, we're wrapping up. I hope I'm not keeping you too long.
No worries.
I'm having too much fun with this.
I know. I mean, shit. This is the stuff that I enjoy. So I can do this all day. I think part of the story there also is I think a lot of folks who've been in the markets for a long time, they sort of remember, what was the sort of 3-4% growth rates, real growth rates in the U.S. back in the 90s. That was good. But the U.S. economy has changed. Just from a demographic perspective, you have much lower labor force growth today than you had back in the 90s. From a productivity standpoint, in general, structural productivity is lower today than it was back in the 90s. And so, kind of like today's 1 to 2% real growth is the 90s, 3 to 4% real growth, and that's a thing that So and to be clear, in the European context, which has a way worse demographic story and a way worse productivity story, actually kind of zero growth in those economies.
Wow.
Is actually, is keeping, for instance, unemployment at secular lows.
Yeah, yeah.
And then you go to a place like Japan, and it's even worse than that. There's some reasons to believe that actually negative growth in Japan is actually still enough to keep. You can have modestly negative growth in Japan and keep labor markets tight and keep the economy kind of, the employment in the economy pretty good. So you do have to have that perspective. And so kind of what feels like a little soft today is actually still likely enough to keep labor markets tight, which is what we're seeing.
My biggest takeaway every time I talk to you is the relative nature of data.
That's right.
It's like, because when the big conversation we had the first time was about the relative nature of currencies.
Yeah.
And you told me that currency valuations are not to be based on a standalone nominal basis. It's relative to the performance of other currencies.
Right.
That changed the game for me, because you could look at an environment which should be, let's say, bearish for the dollar, but you can see like the DXY going bullish, because relative to the performance of other central banks' policies at that moment, America was still, or the dollar was more attractive.
Exactly.
Relativity is a huge. 2 questions. This is going to be a boring one for the phone, and then I'll ask you a fun one, which is where you see the markets going. That'll be the last question. But you mentioned bonds, and so we have to talk about everyone's favorite topic. What do you think the bond market pressures are today? Do you still see any structural problems with regional banks holding these kind of mixed duration assets? Do you see any structural problems in the bond market, specifically as it relates to pension funds holding them and small regional banks?
Yeah. I think the bond market story. If you've been through a few cycles of, let's call it, the regulatory freakout, which is basically what we had, which is regulators got totally caught off sides with the SVB thing, not actually ensuring that the banks were in good shape. This is how it always works. There's a spark. They totally miss the boat initially, and then what they do is they go to they stabilize conditions, which is exactly what they did with their policies there, and then they go into every single bank. And when I say they go into, I mean there's literally a person who knocks on the front door of the office of every single bank, walks in and says, "Open up the books. This bond problem, this duration problem is a problem. I want to see exactly what the problem is, and I want you to ameliorate the problem by dealing with it, whether it's selling the bonds or putting on swaps or dealing with it."
That's got to be fun.
And so I think people are today's bank problem when it comes to duration is totally different than it was before the regulators were aware of the situation. And so I think if you look at the banks, it's been a very interesting period here. We've had 60 basis point rise in interest rates over the course of the year, and we've basically seen flat performance in KRE, maybe up a little bit, but flat performance in KRE. If there really was a big bond sensitivity from these banks, you'd expect to see some real deterioration as interest rates rose. The real only problem bank that we've seen so far through the course of the year, New York Community Bank, is related to specific housing stuff that's going on in the New York City metropolitan area. It's not. There's nothing globally indicative,
of course,
of what's going on with rent-controlled housing in the Bronx, right? Like that's not a thing that's interesting.
There are certain pockets where those regional banks have the same risk exposure. Say San Francisco and New York being the 2 biggest, and the issue is that a lot of the commercial real estate loans are not being marked to market because of obviously everybody's moved out of San Francisco. Commercial real estate took a hit. So you think like if they were to be marked to market, that they would have to call those loans. They would have to get the loans would get margin called. Is there any of these independent sort of risks that could lead to a bigger issue, even though they're not all intertwined?
Yeah, well, I think
system.
Take CRE as an example. Most of that's on balance sheet lending.
Yeah. And
the thing you have to understand with banks, the thing that banks are really good at is lying about the quality of their assets, and it's almost a system explicitly designed to lie about the quality of your assets if they're on balance sheet loans. Right. And so, just as a simple example, since the CRE thing blew up, first quarter last year, banks have accumulated $60 billion in NIM, in incremental income from those loans, and they've booked $600 million of losses. So 1% of the total income that they've earned, they've booked in losses. And the reason why they can do that is because they don't have to mark to market those assets. And so what's going to happen with CRE is we're going to be long. The CRE problem, which is a real problem. The loans, some of those loans are undervalued, are underwater, and certainly the equity holders in CRE are going to get hit. But by the time that gets recognized, it's going to be 5 or 10 years from now. And so
Okay.
banks will have had plenty of time to earn out in terms of their income on an ongoing basis. And frankly, we'll be on to this thing or that thing or the next thing related to the banks. There could be plenty of problems in the financial system. The banks are not going to be the problem. And I know that's a scary, I
understand.
dangerous thing to say.
yeah.
Anytime someone's like, you know what, there will not be a problem. That's
a red flag.
That's a very dangerous place for a macro person to say, because you could always say, well, there might be a problem.
Yes.
But I think the banking institution is a place. Take it from someone who thought that there were going to be trillions of dollars of losses in the U.S. banking system years ahead of the actual financial crisis, and got that spot on. I understand the bank system today, and there will not be trillions of dollars of losses in the banking system. It will not be the problem. There may be other problems that emerge, but it's not in the banks.
And there's nobody better to speak on it. So I really appreciate that breakdown. So, and I really do appreciate the nuance here, because it is hard to parse through all the data to see how big of a systemic issue is this going to be. Do you see any issue? So you're saying that 4 to 5 years is when they're actually going to have to mark to market.
Well,
the issue with the bonds is that they had to realize the losses today, and that there was a sort of a bank run that happened as a result. That's always a risk, isn't it?
Well, from the securities portfolio, this is the difference between on-balance sheet lending and securities. And
Okay.
securities, if they're booked as available for sale. So within securities, there's available for sale and held to maturity. Held to maturity doesn't have to be booked. Available for sale does
okay.
have to be booked. And so this is, what is a bank? A bank is an accounting scheme, right? That's what a bank is, right? Where you earn income today and you only talk about how the assets are evolving when the actual cash flows get impaired, right? That's what banks are.
Yeah.
Right? And it's a beautiful thing. It's a beautiful thing because it creates an infrastructure. There's a stability of the accounting misrepresentations, not illegal misrepresentations, but the fact that you don't have to mark to market. There's a benefit of not having to mark.
Of course, you're valuing everything at the best possible scenario.
Exactly, until it doesn't actually get paid.
Just like you said about equities, which is that the valuation of all these things right now is very high. Now, if the reality does not meet the expectations, and if they do not at maturity or at the time of, like, let's say Tesla or Nvidia, if in the next 6 to 12 months they don't hit those performance metrics, that's when the issues start. When you realize it.
And the beautiful thing about a loan is you don't really have to recognize it until either someone stops paying, which is pretty unusual, because in general people have plenty of cash flow to pay like the marginal interest on a loan.
Yep.
So then it's really when the loan comes due. And then at that point, what happens is the banker is shocked that the person can't come up with, wow, I am shocked you don't have the money. Of course they know that they didn't have the money for years, right? Mm-hmm. But they don't have to recognize it. And even then what they do is they say, well, we'll extend it, we'll restructure it. Bankers are much better at dealing with the bad loans that they've made than they are making good loans. But that's the nature of the system.
Managing downside.
That's the nature of the system, is that they manage that process very effectively. And all the regulators, they're looking to the side saying, yeah, of course, you're doing it in the right way in order to limit financial risk. And so a big part of the story has been, it's not the whole book, it's not the loan book. It's not, in many ways, the available for sale, the held to maturity bonds, because those get marked when, through time, once they actually mature. It's really a small portion of the overall portfolio. And then what's happened is the regulators have come in and basically said, take duration risk off the table.
Okay.
And banks can basically do that. They're essentially booking a loss.
Yes.
In the sense of, like, the bonds, the value of the bonds or the income that they're going to receive is likely to be lower than the income, than what they might have to pay on the liability side. But we can lock in that circumstance and basically say we
eliminate a catastrophe.
We won't have a catastrophe because we've put in hedges. And you see that you probably don't sit around reading regional bank,
little do you know, Bob.
Investor presentations. But for those nerds who do, you can start to see, they're reporting their interest rate sensitivity. Their book is starting to come down. It's not that high.
That's good.
So those sorts of risks, I think, are starting to get meaningfully mitigated. And you're seeing that in the price action, which is interest rates are going up. Even when interest rates were at 5%, which you'd expect if there really was a bond problem in the banking system, you would have expected with interest rates at 5% last year to see a bunch of banks blow up.
Yep.
Crickets.
But is that because the bank term funding program came in and sort of created a backstop for any of the regional bank failures, or without the BTFP, it still wouldn't have been a
I mean,
systemic
the
issue?
BTFP ended up being like tenths of a percent of overall assets in the banking system. It wasn't really the big story.
I just think it was significant in terms of the amount of liquidity put in, because if you look at the quantitative tightening facility, they were trying to remove what it was, 100 billion a month, and then that for 6 months they had removed close to half a trillion, and then in the span of 3 or 4 weeks after SVB, they had pumped back in close to 150 billion dollars and sort of undone a lot of the liquidity sort of tightening that they were trying to do. Do you think that has an effect, or is it different because they're loans and they're not?
Yeah,
direct?
I mean, it's a very short duration, 1 year duration lending on securities. So I mean, BTFP was the bigger story around the BTFP thing was not the actual functional liquidity that was provided by the BTFP. It was the regulators basically saying the financial system will not go down as a function of this problem.
So not just the systemically important banks, but even the regional.
Right, exactly. They said, look, I mean, basically what they said is like, your bank, meaning the bank you have a deposit in, it may have a problem, but we're going to deal with it. And so depositors, don't get concerned. It'll be fine. We'll deal with it. And then that's the whole point of what the regulators are trying to do in that circumstance is to just slow the snowball effect. They're basically trying to freeze everything to say, all depositors, don't stress. Everything will be fine. And then what they do is they take that time to go into the banks and deal with the problem, right? And to, reduce the interest rate sensitivity and, clean up some bad, some of the banks that are in worse shape, they try and merge with banks that are in better shape. And so they, that's kind of the process, is just kind of freeze and deal with over time.
So stop the bleeding first. And then basically, because the panic is what can cause a real...
The panic is the problem.
Is that with all Fed policy? Is that kind of what you're saying? Which is they want to stop the panic first, what could lead to like a lot of unemployment and corporations panicking and things like that?
Yeah, I think when it comes to financial stability concerns, the biggest lesson in the financial crisis was go overboard on stopping the panic, because the second and third order consequences, once the panic starts to spiral, then your problem gets a lot bigger.
Yeah.
So if you can come in and basically say, there will be no panic, which is what they did in SVB on that Sunday night. They said, there will be no panic. So we're going to make the depositors whole. And I mean, they didn't say this explicitly, but like, if you're in some other regional bank and you find yourselves in this circumstance, we are not going to cause you to take losses as a depositor. And what ended up happening? Like nothing. Like people didn't do anything because there was no risk, and that meant that the problem. That's the funny thing about when you talk about these sort of financial stability issues, which is the promise of doing something, then means they actually have to do a lot less than if they didn't promise to do something.
Because the market will front run that decision and be more aggressive in their response than the actual action itself.
Right, exactly.
That's crazy.
Exactly. So that's...
So let's talk about sustainability, because these are the last two questions I have, which is obviously this kicking the can down the road and bailout economy that we've been in since the great financial crisis is clearly unsustainable, because as we're locking in this deficit and we're going to have to really deal with what I think is the biggest issue of our generation, which is I think something like the government debt is that the deficit or the debt is growing $1 trillion every 100 days or something?
Yeah, the total outstanding debt, yeah.
And so when we're talking about the inflation problem, and then we continue to exacerbate the amount of liquidity in the system, there's really no meaningful attempt to reduce spending, to reduce the amount of overall, I want to say activity, but to really reduce activity so we can slow it down. There has to be an end game here where the train hits the wall. Do you see a way out of these different crises?
Well, I think what I'd say is that there's the fiscal position of the U.S. government is running deficits at a level that over time is likely not going to continue to be sustainable. I think one of the challenges is I can say that and lots of other people can say that, and it's a pretty useless thing when it comes to trading markets, because the deficit, the government debt stock might be unsustainable, but like when does it actually influence the market dynamics? Like,
I'm more concerned about the real economy, the real economic impact of, let's say they're going to have to compensate in either creating more revenue for the government in terms of raising the tax rate in America, or just reducing spending, which, as we know anything about the government, that's a lot less likely.
Yep.
And so, if that's an inevitability, are we headed into an environment where we inevitably have to have, let's say, 80s or 90s level tax rates to compensate for the rising cost of servicing the debt?
Yeah, I think Japan is a helpful, it's an instructive example here that highlights the fact that when you have large deficits and a significant debt stock, there are levers available that the Fed and the Treasury can pull in order to make the adjustment burden not so extreme so as to meaningfully impair the real economy. And so as an example, like the debt stock, the Japanese government debt stock is, the largest in the world. But the reason why that is possible is that the BOJ has bought a huge portion of the bonds. And you'd say, okay, at what cost? Well, the answer is actually not at that much of a cost.
Except for to the yen.
I would argue that the yen has mostly been weakening as a function of easier monetary policy. The weakening of the yen has been a good weakening of the yen in the sense of it has been a controlled depreciation of the yen to get it more in line to get Japanese production basically more in line and cost competitive with the rest of lower cost Asia. And so it's not really like the yen has gone down, but it's not a function of the printing of money to fill the gap.
It's more of the sacrificing the currency to prop up the bond market situation.
That's right.
But sacrificing the currency also has its own issues, especially with demographic issues like.
Why is it so bad in Japan? Like I think the Japanese solution, if anything, the story that we've learned in Japan over the last 30 years, is that they didn't print enough money, right? Because
this is why I love talking to you. The contrarian views here I'm loving this. Yes.
And so the path that's going to happen. We've got too much government debt. That's absolutely true. So what's going to happen is we're going to print a bunch of money, and we're going to take the central bank, the Fed, is going to take all of that debt essentially out of the hands of the private sector, so that we don't have to raise taxes, in a way that is intolerable on the real economy, and so that we don't have to cut spending in a way that's intolerable on the real economy. And that's going to be the challenge, policymakers' challenge over the next 20 or 30 years is going to be how do we restructure the U.S. debt stock in a way that is not too painful, not undesirably painful for the real economy, but not so stimulative that it creates intolerable inflationary dynamics. And that's a solvable problem. That's an absolutely solvable problem. It's been solved before. It was solved in post-war periods. It was, there's lots of different things you can have. You can incentivize banks to hold the bonds. You can incentivize, you can just say the yield curve is a certain way. That's essentially the Japanese did that to some extent. You can print money to buy the bonds. This is a solvable problem. The thing that I'd say is, and it's solvable in the context of lots of other places in the world are dealing with large debt stocks. And so when you think about the dollar relative to those currencies, it's also a solvable problem because Europe's dealing with this problem, and China and many other major advanced developed economies are dealing with large government debt stocks.
Of course. The
real question is going to be, do they calibrate it quite right? Do they allow too much tightening, which creates an economic, deflationary economic contraction? That would be a problem. Do they make money too easy, which means that, inflationary problems emerge?
Yes.
And what I'd say is in both circumstances, whether it's too much inflation or too little, too much deflation, we will probably see people move towards hard assets.
Yes.
Hopefully. As an alternative to fiat money in that context. And so the story, for instance, in gold that's going on right now, is, we've seen gold pressing to new highs. It actually has very little to do with what's going on in the U.S. U.S. investors aren't particularly interested in gold, at least at this point. And it has everything to do with how China is dealing with its debt problems. And so I think it's a good analogy to, we may see a circumstance where all the fiat currency, where the dollar might be the strongest fiat currency for all sorts of different reasons, depth of the capital market, innovation, productivity in the U.S. economy, et cetera, but they might be all depreciating relative to hard money.
Hard money, of course. Well, which is basically what's happening now. Is happening. And the biggest risk now is that we may be able to get the consumer inflation problem under control, but we may exacerbate an asset inflation problem, it's a problem if you don't own assets, and it's probably the best case scenario if you do own assets, which the majority of the country doesn't.
It's a particularly tough problem for people who hold bonds.
Okay.
Because no matter what, if we have too many bonds, then they've got to get cheaper in one form or another than how they're currently priced. And it's a good thing if you hold things that are not easily devalued through money printing, which is things like gold.
Okay, got you. So then I guess the last question I would have would be, so we were talking about the sustainability of the government debt problem. Now, if you're a modern monetary theorist, then debt is relative. And so as long as the relative debt across the world is rising at similar levels, the game is sustainable. What I'm referring to is the kicking the can down the road in terms of never really dealing with financial crises and never letting the air out of the bubble. And even though we have had a bit of a slowdown, there's a ton of zombie companies that are still around. And I'm wondering at some point, will we have to reckon with the kicking the can down the road in terms of not dealing with these crises, or is there a soft landing scenario there? My generation is going to have to deal with these problems, Bob. We need some guidance. We're going to have to deal with these. I want to buy a house and have a family, and you're telling me I have a 90, because you're talking about post-war periods, after World War II to deal with the deficit, it was 90% tax rates.
Yeah, that's right. It took about 40 years. That's right.
I don't know if Americans are going to accept anything higher than a 50% tax rate today because of, just because of the current demographic.
Yeah, I think it's going to be a challenging, dealing with those sort of legacy issues, essentially. It's going to be particularly challenging. I think they are solvable, but I think it's probably going to take a lot of conflict, because at the core of what you're describing is who are going to be, there's going to be a process where the outstanding debts that exist in the economy and the areas that are propped up are going to have to get reset. And the question is, who is going to pay for that?
Yes.
Either explicitly in the sense of like higher tax rates,
Yep.
or implicitly from the perspective of like, are we going to run, are people in the younger generation never going to be able to buy a house, right?
Yeah.
Because we've created house
Asset
price
inflation,
inflation,
yes.
right? There's winners and losers in that circumstance.
And
right?
picking who's the winner and the loser is a game that no one's going to vote for, because when politicians want to get reelected, and this is what's so difficult about, let's say, no one is going to cut spending in Congress because the entitlement benefits is their voting base.
Yep.
So as soon as you cut Medicare and Medicaid and Social Security, you're going to have a lot of unhappy voters. It's not the young folks that are voting. And so the cutting of the spending for entitlement benefits is out of the question. And so we're either going to have a productivity boom that outpaces the rate of the debt, which I think AI could deliver.
It's certainly, I'm betting on America to come up with a productivity solution is, over time, over the last 300 years, has been a good bet.
I like that. That's probably the best. That's the best way to end the conversation. So we had the most pessimistic conversation up until now, and then we finally finished off with something positive, which is don't bet against America. Or American ingenuity or American productivity.
Exactly. I think anyway, it's any person who studies markets and economies over time has to at least acknowledge American exceptionalism. And so, so don't bet on America over time. I think functionally probably what's most likely to happen with that is either we're going to create a political constituency that's going to force essentially the gains that exist in the older cohorts
Yes.
to be at least somewhat transferred to the younger cohorts in order to create an acceptable outcome for younger cohorts. Or I think actually what we're seeing today is the way that that's getting resolved is through the intergenerational passage of wealth.
Yes.
And that essentially what's happening is the private sector is recognizing that there's an intolerable divergence between what the older generations have and what they're receiving in terms of benefits and what the younger generations have in receiving benefits, and basically just doing the transfer on their own.
Yes.
There's a lot of societal implications of that.
Is there a way to do it without it being a socialist sort of movement? Because when you're talking about transferring wealth around, both implicitly or explicitly, there's like a bad feeling that goes around that narrative. Is there a way to do this in line with the current demographic perspective of Americans?
Well, I think the main risk is if you essentially leave it to the private sector the way that it's happening now. And when I say that, I mean most millennials who are buying homes have some support from their parents, as an example, right? Like that's an example of what's going on. The challenge with that is that it creates intergenerational concentration. So the people who were the haves their offspring are more likely to continue to be haves.
Yes, of course.
And it locks out the people whose parents were the have-nots in a way that I think certainly is inconsistent with the strategic values of the U.S. economy and what drives dynamism in the U.S. economy. What drives dynamism in the U.S. economy is the fact that it doesn't matter whether your parents were on Wall Street or cleaning the floors. Like, you too can succeed. Yes. Right, you too can be as successful as anybody else, and so that's the main risk, is by leaving it to the private sector that you start to undermine U.S. dynamism versus creating an environment where the government is distributing that in a more egalitarian way, so that they're recognizing that necessary transference of wealth or to the younger generations, but creating that equality of opportunity. And that's going to be where the tension point is. And I mean, look, that's above my pay grade, how that's going to play out over the next 34 years. I'm trying to figure out the economy in the next 3 months. Relative to what's priced in. That's what I'll give you.
That's awesome. That's incredible. So people are disadvantaged until they have some way to clear the edge, like finding the unlimited ETF, which can give you that same access that institutions have. We'll have the link in the description below. Bob, thank you for having us.
So much fun.
Thank you so much. And ladies and gentlemen, we're going to be clipping this up. I know it was a pretty heavy conversation for most. I'll add some commentary in between if needed, but thank you guys for listening along. And Bob, thank you for incredible insight.
Thank you so much for having me.
Wealth of knowledge, and I can't thank you enough.